2. Hey folks, do you know what? I actually announced Michael a bit too soon. I forgot about the whole chairs thing, so my fault there. And listen, we haven't done events in 2 years? So I would love you to give the loudest, most raucous, suitably rock star welcome to the moderator of our opening panel. One more time, even better this time, even louder. Please welcome to the stage, Michael Caselli! Awesome, dude.
Hello. I love being back in Malta, and this is an amazing venue to have a show. My name, as you have just heard, is Michael Caselli. I've been in the industry for, about 24 years now, and it's my great pleasure to be moderating probably the most exciting, I think, panel of this entire show. We're talking about bulls and bears. We're talking about investment. We're talking about M&A. We're talking about capital markets. And joining me to do this are three guys with three very different opinions on this subject, which is going to make a pretty interesting firework explosion type of a panel here. I've got Julian, the co-founder of RB Capital. He's involved in investments, M&A, and he's got a brokerage that has taken companies from zero to hero, essentially. We've got Richard Carter, who you probably all know, CEO of Bragg Gaming, and he's had an M&A-filled career with several very, very successful exits and mergers and acquisitions, including, and is now providing Bragg Gaming as a content partner for the industry. We've got Tim Heath. He's a general partner of Yolo Investments. Now, you might not have heard of Yolo. They're kind of new. But Yolo is a VC that's investing in the fund, and they're looking at Series A in startup-type companies. So we've got three very different points of view coming in and talking about this market. M&A is nothing new in this industry. In fact, when I was asked to go on this panel, I started to think about my own career in the industry and kind of the acquisitions and public markets that we've worked in. And I think it started, for me, with my first sale to a PLC through Bluff Magazine being sold to Churchill Downs. So that was the first time we had to interact with a big public, highly regulated industry company in this industry. And it was interesting to see how they operated and how they were slightly different from what we did as a very entrepreneurial startup that grew, successfully, luckily enough, during the poker boom to go be acquired. Then I was approached by a PLC listed in London called Electric Word. And through that, we launched our magazine's iGaming business and some of the conferences that you've probably attended. And then worked as a partnership with myself and the PLC in, again, a very regulated environment. And eventually, we sold that PLC, or that business was acquired by Clarion Gaming, where I now work as the chairman of the gaming division. So M&A is nothing new, but it is probably the most exciting time. Why is it exciting? Because the numbers are huge, because the capital markets globally are interested, because it's not just London and Stockholm that are interested in gaming companies, it's now New York City, and gaming is now global, worldwide, recognized as an investment that has years and years of return. So to talk about that today, I'd like to introduce my panel and bring them on the stage. Come up, guys. A round of applause. So I promised fireworks.
Okay.
And I know we're going to deliver. So let me bring up my notes, because we've had a number of conversations, and I know where each individual on this panel sits as far as their opinions in this space go. So I'm going to start out with a fairly non-controversial statement, and just say we're in the midst of a great bull market in this industry. Would everyone on the panel concur, and do you want to add something about that?
Yeah, I think it's clear from the sort of M&A that's going on, the valuation expansion that we've seen, sort of, I guess, as soon as the US opened up, we started to see a lot more interest from US investors, and that started to lead to this multiple expansion. And then recently, you've seen this, obviously, acceleration in M&A, specifically a lot of US focus. I'm sure everyone saw the Aristocrat Playtech acquisition over the last few days, which is a bit of a game changer. They were one of the anomalies in terms of the industry that didn't have their content online, Aristocrat, and they've obviously are the top performing content in the US and globally in most markets. So that's obviously driving this significant expansion in multiples. So yeah, I think it's undoubtedly we're in a bull market, no doubt about it, at the moment.
Julian?
I concur. I think it's a great time to be in the M&A space, especially if you're a broker, especially if you get remunerated on valuations, right? That's what brokerages should do. I think the US has really helped, particularly to drive up valuations. But then at the same time, there's some worrying signals, right, which could, based on other industries, indicate that we might be heading towards consolidation in the not too distant future. There's a few concerns, right? I think the Aristocrat Playtech deal was actually quite good. I think 11.4x EBITDA was actually a really good transaction. But then when you look at transactions like Penn's acquisition of The Score, right? I mean, a $2 billion based on what, right? Based on expected revenues of 50 million next year. So we're all talking about forward projections, and historically that tends to show you that you're in a bubble which is rapidly accelerating. So I'm enjoying the M&A scene right now, but I am concerned around what lies around the corner, if that makes sense.
So cautiously optimistic for now.
Yep.
And Tim?
Yeah, I think for me it's all this SPAC business, which I don't quite understand. I don't think anyone really understands what's going on with it, that it's like, here's a vehicle we're going to use, we're going to put something in it, we're going to raise money, and good luck. Now, this is good for a market to be in a bull market, no doubt about it, but it will come to an end and it will crash hard. And you're right, Julian, the multiples they're too inflated. I've seen this in the crypto world as well, and it's great while it's happening, and there's nearly FOMO. For all European slots or platforms and whatnot, trying to put their eyes on the American market, but not really realising they need to work in the American market, which is not the easiest market to work in, given the compliance and regulations. So certainly enjoy it while you can, but remember, I wouldn't just take equity in the new venture. I would take some cash off the table if you're a European company going to America.
So again, a little bit more conservative outlook.
Hedge.
I think we've got to sort of take a step back and look at the ecosystem. And in the US, it's not just about what's the TAM, but you've got all this much bigger ecosystem. You've got sports, you've got media that are all playing its part. So that when you're looking at these valuations, you've got to be a little bit careful. Also, if you look at US, how they value technology companies versus European, it's always at a significant premium.
That's true.
You can see that with a lot of the fintech listings are going to the US because they seem to have a better appreciation of looking longer term. Then if you actually look at the TAMs, if you believe them, I'm a bit skeptical on them, but if you look at sort of the US market at maturity, 30-odd billion sports betting market size, probably 40 billion if iGaming becomes fully legalized. So you're looking at a $70 billion, $80 billion TAM. And so when you're looking at valuations today, and you're looking at that market opportunity, you know, if it depends obviously what market share you assume, but you actually can make quite a credible sort of valuation case for it. And that is why, when I obviously speak to investors a lot on the subject in the US market, and that's how they're thinking about this. They're looking at what are the disruptors, looking at technology, which is obviously very important, and that's one of the drivers of M&A at the moment. And then looking at what can these companies, what market shares can they attain, and then what's going to be their medium-term profitability. And obviously within that analysis, there's a hell of a lot of unknowns. And so when you come to the valuation, and I think you're beginning to you started to see that this year, where you had this big spike in valuations in sort of January, February, March, where everybody was buying everything because of the fear of missing out. The market effectively crashed. You saw all of the share prices fall by 50, 60%. And now you've had this new sort of catalyst, which is the M&A, which is now sort of getting investors. And I think one of the concerns I would have if I was an investor is actually what we've had over the last 24 months is this new markets regulating. Once that starts to slow down, and then the market shares that people are assuming don't start to come through, because obviously, as we all know, it's a lot more competitive and it'll move around, then I think you might start seeing a little bit of pressure on the valuations.
True, but let's consider 3 mergers. Playtech Aristocrat, SBTech DraftKings, Bellies and Gamesys. Most of these operations have skeletons in the cupboard because that's what the industry was for so many years. And grey is not a bad thing, just to be very clear. No. But coming to America, it needs to be crystal white. Yeah. Now, how do you do that, and then at this valuation come in there, and then all of a sudden things are discovered or reported, i.e. the DraftKings and SB Tech, the market doesn't understand it. We, as an industry, understand it and appreciate it. And most UK PLCs have an Asian arm, but just run by someone else. So it's not unknown. But in the American market, which is very sensitive to price and to skeletons, that will move a share price, and I believe bring it into the bull market.
No, I think that's really, really interesting sort of area of what's going on, because obviously when you get a 300-page prospectus, most of the analysts are not reading through those 300-page documents where it clearly sets out the regulatory risks. And I think when you started to get this sort of SPAC thing happening, the thing with a SPAC, if everybody, just to be clear on a SPAC, the SPAC acquires the company, and there's a lot less due diligence done on that process, where if you go through a normal IPO process, you have to go and see, let's say, 100 investors, and they will give you feedback and determine the price, where a SPAC effectively sets the price, and therefore they don't do you could argue they don't do the requisite level of due diligence, because a SPAC timeline is about 2 years, and they need to do a deal to get paid. But I think the interesting thing on grey markets or on Asia in particular is that I think over the last 3 or 4 months, the analysts in the US and investors are now getting their head around this. They were blindsided. They didn't really understand it. This grey markets, what's grey? Is it Finland, Norway? Is China grey? That type of thing. But I think now they're definitely getting a bit pickier. They're asking the right questions. And as part of our overall revenue mix, I think, if you have a portion of grey revenue, it's okay. I mean, I can give you my own personal experience of dealing with multiple regulators in the US, sat in front of them when I was going through licensing with SB Tech. I won't repeat the expletives, but they didn't care about Asia. As far as they were concerned, they don't care. But the analysts and the investors are now beginning to care about it, because people are talking about it. So there's a healthy debate. But I think what you're finding is they're beginning to sort of just put it as part of the risk spectrum. Yeah. So I think it will gradually get accepted. But if you're aristocrat and you've got 300 licenses around the world and you're licensed in Nevada in certain markets, then I think it's very difficult sitting in front of that type of regulator and justifying potentially China or those other markets. So I think there'll be a zero tolerance, and that will slightly clean it up as well. But I do think there's shades of grey when it comes to Asia. So yeah, I think it's playing its way out, that sort of whole Asian story and grey markets in the US. The analysts are getting a much better understanding, so are investors. So it'll be quite interesting to see that dynamic play out, actually. But it's definitely a bit better understood now. Yeah. I agree with you. It was very poorly understood previously.
Let me interject for a second. We're talking a lot about SPACs. For those of you who might not know, they're a fairly new phenomenon in the finance world, becoming very popular in the last couple of years. Essentially they're shell PLC companies designed to acquire something that's going to go into that shell, giving the company that's acquired an instant listing on a public exchange. There are 20 SPACs, maybe a few more actually than 20 SPACs that are currently interested in iGaming, and at least $6 billion has been raised by SPACs for gaming in 2021 alone. So pretty important new vehicle to get a listing. Skeletons in the closet, interesting topic. Of course, when you're moving into the US, you're going to go to the US with a US partner who's heavily regulated, who's going to make sure that whoever their partner is whiter than white, because gaming regulation is just as strict in most states as is financial regulation. But at the same time, I think you're seeing a lot of the PLCs in Europe, whether they're on the Irish, London, or Stockholm markets, already sanitized over the past few years. Which leads me to ask this question. Do you think the skeletons in the closet problem is something that's largely been solved by European companies, or is it something that's largely been, ignored up until now because they didn't have the impetus to go and completely sanitize?
I think we're still going to see issues with European-based stocks with skeletons in the closet, because they can come out of anywhere, right? I mean, a year ago, 2 years ago, who thought that ESG would be an issue, right? Now it is. And that's why all the Swedish stocks in large extent, have taken a tumble over this year, right? If it's not ESG, it's going to be some sort of pre-regulated traffic. Let's call it pre-regulated traffic for now. We're seeing all the Q3 earnings reports coming out now, and everyone's taking a haircut, right, on Germany, on the Netherlands, right? Who knows what's going to happen over the next few years? So I actually think what the US is doing is taking a leaf from European operators as they continue to learn. The advantage there, right, is an M&A advantage. They see European stocks as being depressed and potentially then be able to make a punt and acquire which assets potentially on tech. I agree with Richard on this. I think the US loves tech because they love full stacks. And tech is valued significantly higher in the US in terms of multiples than it is this side of the Atlantic. So I think it's going to continue. I think we'll continue to see more skeletons in the closet, whether it's lack of due diligence, like we saw on the SB Tech deal, or effectively pre-regulation, or wherever you might get some whistleblower, right, as we're seeing with Facebook right now, just talking about ethical practices. I think it's just going to continue. I think it's a natural state of economy.
Well, we're also seeing a lot of retail interest in the space. So retail investors are now involved in iGaming much more than they had been in the past. And I think there's much more knowledge from US retail investors about iGaming. And of course, a lot more institutions and institutional investors getting involved in the space. We actually even have an ETF, Roundhill Investments, which is listed on the New York Stock Exchange. That's now created an index essentially for a number of gaming companies. Do you think that the retail investor is as sensitive to these skeletons in the closet, or do you think that that's not something that the American investor is, on a whole, mostly focused on? Because it feels to me like American investors are just very bullish on anything iGaming.
Or they check Reddit and Robinhood and follow that.
Yeah.
At the end of the day, retail investors, they're not at the forefront of making a market move. They're just trying to make money. If it's a hot market, they'll want to jump in there. If it goes down, they'll jump out. I think most American retail investors are happy that they can now play and gamble legally in their country. At the end of the day, that's the biggest exciting thing for them.
I agree with that. I also think, though, the platforming thing is becoming something of a trend, right? People want to have a voice. People want to talk about what their stocks are. And if there's a platform that allows you to do that, then retail investors will talk, right? We saw what Simply Wall Street, right, on Reddit did earlier this year, right? As long as there's this momentum effect, which then leads to FOMO, I actually think the retail investors will get involved.
I think, well, if you're running an IR strategy of any firm, I think you've got to definitely have and put resources behind looking at retail investors.
Mm-hmm. Yeah.
Because on these sort of chat rooms and things like that, they can have quite a detrimental impact on your sort of, the sentiment around the company. So it's definitely an area that you need to focus on. But in terms of the volume, it's still institutional investors are still like 95% of the volume. So that's what moves stock prices.
Have you seen any investor relations teams actively looking after that retail investor market? I feel like the retail investor market is more fueled by the hype and the knowledge that iGaming is coming to your state, or that sports betting is going to your state, than anything else. So it seems like the first introduction, perhaps, to any listed gaming company is the fact that your state is now going to be offering sports betting.
I think the investment world has changed quite dramatically over the last sort of 5 years, and there's obviously now a lot more family offices, which have a lot of wealth. So if you're running a sort of tier one investment strategy, then you're going to definitely spend quite a bit of time focused on family offices, and there are thousands of them, in Canada and North America. So that would definitely be an important sort of focus. But you've got to take that whole sort of cohort of investors into account. So retail, family offices, and institutional. You're obviously not going to spend so much time on retail, but it's just you need to consider them.
I guess just building on this point, because I agree with Richard on this. I think what you need to see is where the market's going to be in the next 6 to 8 years' time, right? Mm-hmm. What's going to happen? Let's talk specifically about the US. I'm not sure gaming or iGaming per se is actually well understood, right? What is understood is that media companies are buying heavily into what effectively is sports betting, with hopefully a leap into casino. And it's, at least from my perspective, it still stands to see, right? If that's going to be what effectively is a mainstream stock to invest by the end of this decade, right? Gaming right now enjoys, let's just say, a slight bump, particularly because they were COVID resistant, right? So they're normally seen as good stocks to be able to pick. What happens between now and then, I think, is going to be dependent on how the media companies effectively are going to fight their way through, right? Spendings aggressively, right? I mean, just look at the NHL or the NFL over the weekend, right? Just to understand how aggressively you see these spends, to see who's going to rise to the top, right? To be able to control all of the media channels, to be able to leverage even more sports product at a cost to customer acquisition, because right now it's definitely going through the roof.
But then on that point, if it's costing so much and people are spending so much to acquire and get market share,
Is it sustainable?
What happens in that 4 to 5 years when it does, you've got to turn a profit, don't you?
Yeah.
That's how I was always taught in business.
So,
to
well,
be cash
yeah.
flow positive.
I was always taught it's all about cash. It's always focused on cash. But I think in terms of the US, I think that's why you're starting to see a lot more M&A. Because if you look at the model in the US, you have 100 of, let's say, GGR. Let's say on average you've got 25% taxes. You've then got to pay your sports betting, NFL, a fee there, so that's another 2 or 3%. Payment processing can range from, say, 5 to 10%. Then you've got to pay, if you're doing a skin deal just to get access to the market, let's say 5%. So actually, you've lost
$1,000 CPA for every customer.
Yeah, well, that's bottom line. I'm looking at gross profit margin. So basically, you're at 50% already.
Yeah.
So then you've got technology costs, you've got marketing and everything else laid on top of that. So the only way, theoretically, in 3 or 4 years, 5 years' time to justify some of these valuations is that you need to have 30 or 40% market share.
Yes.
And therefore, I think it's only a matter of time where some of the smaller players in the US will have to get together and consolidate. Yeah. And that's one of the sort of, and you've got the DraftKings Entain thing at the moment, and we'll see how that plays out. But I think you're going to get more of that because, if you're sat in a DraftKings boardroom, you know all of this, so you're planning for the next 3 or 4 years because you know that if you don't do these moves, as you say, the cash isn't coming through, then you're not going to be at $50 or $60 share price, you're going to be at $20. So that's sort of one of the thought processes.
$500 million on marketing, when are you going to make that money back?
It's an interesting point. I've dug into their numbers, actually, funny enough. You're right, they spent DraftKings spent $495 million last year in marketing in the U.S. market and lost $1.2 billion in 2020.
Yeah. And they'll spend close to $1 billion this year on marketing.
Yet they have a market cap of $19.82 billion, which is pretty impressive. FanDuel is not even predicting profit until 2023. Yet Flutter's market cap, which includes FanDuel, of course, is $25 billion.
But you've got to put it in the context. You've got, from these companies, they're in 20 markets. Right. And each market has theoretically has an investment cycle of, say, 4 years to getting cash back. So big investment year 1, year 2, normalize year 3, and then you start making, theoretically, cash flow and profits in year 4. So when you look at these companies, they've got staggered, they're in 20 markets, which has different cycles of investment. And then obviously if you can get iGaming, that's a game changer for these companies in terms of their cash flow. As we know in Europe, most companies are sort of 50-50. So, when you're looking at the valuations, you've got to take into account, they're investing for the future. So
sure. And that explains the wide range of PE ratios. You go everywhere from like 92 for Entain to 127 for 888 to about 30.
Yeah. I don't think anyone looks at PEs anymore. I was thinking that when I spoke to you and you were talking about PEs, and I'm thinking, I can't remember the last time anyone talked to me about a PE in the online gaming sector. It's now revenue multiples.
Right.
Revenue multiples. So if you look at all the
either
stocks
way,
in the US,
a similar metric. The point is the paper is oftentimes cheap for iGaming expensive for iGaming companies.
Well, there's a couple of things going on. You've got the US sort of B2C companies that trade on, they don't make any money. So they valued on revenue, 15 to 6 times revenue, which, for us in this industry, we've been doing it for a long time, is just absolutely insane.
Yep.
And then you've got the European guys, the 888s, the Betfairs, Entain, which actually trade on 3 or 4 times revenue, and they have, EBITDA multiples ranging from 10 to 20 times, which is, they've got real businesses and good cash flow. And then you've got the omni-channel guys in the US, which are people like the Bally, GameSys, the Penn Nationals, who again have the cash flow, retail sort of base, and then they're moving into the sort of online. So, and they trade actually on not too reasonable multiples. So there's quite a divergence in terms of when you look at the different companies. Yeah.
Sounds like we're in a bubble. Sorry.
Sorry?
Sounds like we're in a bubble here.
It is a bubble, right? The question is, when do you call it, right? This is it. Because, I mean, Bitcoin's arguably been a bubble for a while, right? We're just enjoying the rise and rise and rise and rise and rise. If it continues to rise, it stops being a bubble, right? Question is the US in a bubble which is going to burst? My feeling is at some point it will, purely because the spending on cheap money can't go unchecked. And at some stage, I agree with Richard, at some point the market's going to consolidate, right? There's just going to be 4 big media hubs, conglomerates just offering a one-stop shop for everything. In the meantime, there's actually going to be a bloodbath, right, for companies frantically trying to sell, and then it goes very quickly from a seller's market to a buyer's market.
Well, and that makes me ask, we're looking at all this M&A activity, we're oftentimes seeing US acquiring European. Are US companies looking to acquire cash flow so you could start to justify your multiples in the US?
Possibly, yes.
Is that a driver, is that the impetus?
Or use that Asian money that is off the books to come in and fund your expansion into America.
Yeah. Richard?
Yeah, no, I sort of agree with that. I mean, it all comes down to what do you think the size of this market's going to be in the next sort of 3 to 5 years, and what market share you can get. DraftKings have set it out in multiple presentations, if they can get that, then you can justify their valuation. Right. And you've got to remember that, and then at the backdrop to that, you've got all the media companies that have got, obviously, huge balance sheets, that are increasingly looking at this sector. So you've got ESPN, and they're trying to figure out, like, what's the value of owning a sports betting sort of business, and how does that fit with my media business, and how can I bring that together, and is 1 + 1 4? And I think the jury's still out on that. So you've got those sort of underlying drivers, and I guess as we go forward, if the markets don't regulate as quickly, or they're not growing as much as what's predicted, and we don't have the iGaming casino regulation accelerate, then it's going to be very difficult to justify
those valuations. Then how long can you hold on to waiting 5, 10 years for more regulations to California, the Floridas to come through? Do we wait for that time, and is there enough money to still be spent?
I agree.
To get there? At the end of the day, it's a buy and there's a demand and supply.
And
absolutely.
And there's Las Vegas Sands.
Yep.
They're obviously now looking at getting into online gaming. So actually, there's still a lot of people over here that haven't really even started to get going yet. So you've still got a lot of buyers, a lot of people over here, which I do think will, over the next 12 months, will accelerate, and we'll see more M&A, and so should theoretically keep this sector, in terms of multiples, relatively robust, if nothing else happens on the sort of regulatory front.
Right, and that's if the sector hits its numbers. I mean, last year I think U.S. iGaming was something around $2 billion in the top 4 states. We're looking at about 28 states with some form of sports betting currently, maybe 6 more on the go, which may come to fruition in the next couple of years. I think Maryland might have just announced that they could be delayed, but some more on the way. But you're looking at base projections for 2025 of like $6 billion in the U.S. It seems like we're a long way off getting to that $40, $70 billion number.
I think, look, what we know right now is that the iGaming market, just New Jersey, Pennsylvania, and Michigan, is a run rate of $5 billion. And then you've probably got similar for sports betting. So iGaming is the game changer. You get more states with iGaming. It's very clear. You can see the numbers that it could easily be 10 to 12 billion. That's real cash. That's a real market. Sports betting is a lot more seems to be a lot more competitive. So I think the iGaming market is definitely, you can justify where we're going on that. The sports betting market, you've got good visibility to sort of 10 billion pretty quickly. So yeah, we need to get some more regulation pretty quickly to sort of be getting up to those maturity numbers.
So one question for you guys. You've got $10,000. Which stock in America do you invested in today?
Well, I'm going to, obviously, my stock.
Not Bragg, not that one. You're not allowed to invest in your own.
So you didn't want retail investor.
I think the Bally Games guys are very smart, and I think having a retail footprint with that cash flow, and I think the iGaming, because I'm obviously speaking my own book here a little bit, but that's why I might brag. I think the iGaming sector and casino sector, I think, has huge upside in the US. Yeah. It's going to be competitive. So a Bally Gamesys with all the Gamesys sort of technology and thinking, as you sort of, build out the regulation of iGaming on a reasonable valuation, I think is where I'd probably put my money.
Julian?
I'd put my money in a data company that supplies the sports books. I actually think that's going to go a long way. US loves data. Multiples are 20, 25x of sales as opposed to EBIT. Failing that, I'd put it in some NFT-based avatars of companies. If only there were companies like that out there.
You, Tim?
Evolution.
Tell me why.
They're the quickest to market, they've got the best products, and they've got an aggressive strategy. It's a difficult market, obviously, but they're going to push forward, and it's going to be hard for the next live dealer to get in there and follow their coattails.
They're buying their way to
Market
the
share,
top.
as we talked about, is they've got a great product.
And now a similar question. Who do you think is rife for acquisition currently? Who do you think is going to be the next to be taken over?
Oh, I can tell you about 4 I'm working on.
Yeah, I think I'll exclude myself.
Without
going
breaking
to.
any of your confidentiality laws.
Exactly, yeah. Everybody is looking at America wanting to be acquired because these bullshit valuations are out there at the moment, and they're all eye in the skies going, we can get this amazing deal and cash out.
Right.
I'm working on a deal at the moment I can't talk of, but they've just acquired a lot of businesses earlier this year. And I actually think that one of the main reasons is for them to look more attractive when it gets to an acquisition front. Expect that to happen in the next 3 months. Watch this space.
But as a VC, I'm happy if people want to go and spend a lot of money and buy these companies.
Buy it quickly before the cash runs out.
Buy quickly. Richard?
I'm not going to talk about any particular company, but I do think that there's definitely a growing wave of consolidation on the content casino side. I think you'll continue to really start to see that accelerate because you've got real IP, and I think the other sort of theme is definitely a lot of European-based casino providers wanting to get into the US, but the barriers to entry are huge, and the time to get into the market is huge. So I think there'll be quite a bit around that area in terms of which, is where I'd be focusing if I was looking at investing.
I am hearing that coming out of Wall Street. I'm hearing a lot of people saying, listen, I want to get involved in the tech side, not necessarily on the operator side. So it seems like people are looking at additional support verticals to invest in rather than just the headline operator sites. Now, I believe we have something called Slido, our virtual microphone. Has any questions come up on our Slido before we end this panel?
Hello again. I am master of the Slido today.
Fantastic.
And do you want to have a look? Obviously, the first question, are there free drinks? That was just from me.
Are there free drinks?
Yes.
Probably.
So, probably. Excellent. Good answer. That's what I was hoping to hear. And these 2 questions here, we're coming, you've got about 3-4 minutes, but got a couple of cool questions there. Thank you.
Okay, super. So, let's see. Are regular license required for I think it is meant to say, it says regularly, but I think it is meant to say, are regulatory licenses required for affiliates in the USA?
Yes.
And do you think that they should be licensed off the back of the operator or licensed independently as affiliates?
I'll take the
Debate
first.
I had last night at the bar.
Yes. Regulatory licenses are required in the US. It's one of the biggest pain points, right?
For affiliates.
Yeah, for affiliates, right? And I think Tim mentioned this before. The pain you have to go through just to get a regulatory license almost needs to justify the cost, right? The pain plus also the return on that. Is it something that you can passport off the back of an operator? Yeah, potentially, but I don't know if there's any operators who are actually willing to take that risk, especially seeing what's happening now. So unfortunately, as we expected with the US, it's going to be a very slow, very meticulous, iterative process, which might not be of interest to a lot of European contenders, which is one of the reasons why the US isn't the silver bullet that's going to solve everyone's problems. That's just my 2 cents.
And the next question is about tax. What are your thoughts on how a 15% global tax will affect the share price and investments in the sector going forward?
What
So
tax?
it just says a 15% global tax. So I guess we could ask generally, if your
Corporate tax,
jurisdiction is going to add a tax to your operations, of course,
Well, I
I
mean,
suppose it
obviously-
should translate to the bottom line, but
Yeah.
will that affect the appetite for the sector?
Well, from a US perspective, obviously no one's making any money, so it's pretty irrelevant in the near term. But I think, if you look around, I think most companies are probably already at that sort of level, maybe a bit lower. And obviously, with them going into the US, the ones that are profitable are paying, probably much higher rates than that. So I'd have thought a 15% corporate tax going into the medium term would be sort of below what most people would be assuming, so I think it's a good thing.
But look at POC in UK when it came in, look at Germany, the operators will build this in and make a worse experience for the players to cover their backside.
Are we talking corporate tax or GGR tax?
Corporate tax, but I'm
tax,
saying the introduction of a new tax, be it POC, GGR tax, it's a way to incorporate it in there, and operators will try and cover it somehow.
Well, Look, I'm moderating a panel later this afternoon specifically on Malta's impact, right? Because one of those is going to be 15% tax. I think there's going to be a significant impact, particularly with jurisdictions, not the US. I think the US is okay in this regard. But I think with jurisdictions who have enjoyed that 6/7 clawback, right, of tax on your profits, I think that's actually going to be a material impact. And couple that with regulation, couple that with erosion of profits, couple that with FOPT in the UK. That's only so much you're going to put straws on that camel before the back breaks. That's just my 2 cents.
But I think a lot of the operators in the room would probably agree that a little more tax is probably better than terrible regulation or a ban on marketing, because that would ultimately drive the black market to do better, and that would depress the entire market, and then no one would achieve.
But there is a need for a strong lobby group to be able to go back in a unified, homogeneous way to the necessary jurisdictions in Europe. And there's never been a more important time than now. There has to be a unified voice that the gambling lobby needs to go, just like gun control did in the US. I mean, if they can do it in the US, why doesn't gambling do it in Europe over here? There has to be a reasonable amount of very good points put forward that gambling tax is necessary and it's important for the economy, but it needs to be measured to allow operators to survive.
I think we might have time for one more, so I'm going to choose this one because it's a good open-ended question. What's your prediction on how long it might be before we actually hit that bear market? How long do we get to live in these bullish days?
3 years.
3 years?
But possibly
2 to 3 years.
Possibly a bit less because of what's happening to SPAC regulation. So if you've seen the SPACs from this year, right? We reached peak SPAC in Q1, right? Q2 leveled off, and Q3 is actually significantly lower. And that's because there's some changes in the US regulating what effectively is cheap money, as Richard correctly said. If cheap money runs out, then consolidation will happen. So I'm calling it between 18 to 24 months.
18 to 24.
Yeah, I don't disagree with that. Obviously, a lot of it depends on the regulation momentum in the US, and obviously, you know, the appetite for continual M&A. And if we then start to see the sort of media and gaming all fit together, that might continue for a little bit longer. But yeah, I think a couple of years, because by the time you get sort of out to, where are we now? So into 24, I think the TAMs that people have been predicting may not happen, just because it takes time. We all know, like regulation, you know, trying to get casino, you know, into new markets is very difficult and fraught with political nuance. So yeah, I think, you know, a couple of years. Obviously, if we got some big states going, you know, Florida, California, or something like that, that might sort of continue it. And then maybe there's a pivot away to more global mergers. And then maybe we could have Japan or some Asia-type regulation, which might kickstart it a little bit more. So, so I think a couple of years seems about fair. And then if regulation continues, then it might prolong it for a little bit longer.
But in 10, 20 years, Disney is the key to the American market, I believe.
Or Netflix, who gets there first.
Yeah.
Yeah, I agree with that.
So we're looking at a fairly short horizon, given that some of the companies are not predicting profitability within that period. We're saying to look globally, not locally, for new markets to emerge, to drive the market forward. And it seems like we may right now be living in the halcyon days of iGaming. So enjoy it while we bask in the sun. Ladies and gentlemen, a round of applause, please, for Richard, for Julian, and for Tim.
Thank you.
It's been my pleasure hosting this. Thank you very much.
Thank you.